Gold will be able to quietly creep up back to new highs, maybe silver too, although 120 is a bit high, but certainly over 100 by the time gold makes a new high. But who knows? I mean, maybe silver will rip again and beat gold to new highs. But I think once gold makes a new high, or maybe has to get over 6,000, you're going to start to see a lot more money being focused, retail investors, especially if we get a crack in the stock market.
However, if this breaks down, we'll be back on the bull trade. So bear in mind, it hasn't shown its hand yet. I have a slight bull bias here that concerns me for gold and silver. I'm not so convinced that you'll make a new low. I think you'll probably bottom before. We have a broadening structure on gold, and we have a falling wedge on silver.
After hitting a record $5,405 in January and pulling back 15%, gold is in an environment where Citi's caution is easier to understand. The macro risks that justified owning gold as a hedge are still real. But the question now is whether they will intensify further or stabilize. Gold's ability to return to record levels depends on new catalysts, not just the continuation of old ones. Citi's message is ultimately a call for selectivity. The bank still sees a path to $6,000. It just does not see that path as the most likely one. And for investors who bought gold when it was a contrarian trade, that is worth sitting with before adding more at record prices. Renowned economist Peter Schiff and technical market analyst francishunt bring two distinct but complementary perspectives to the gold and silver markets. In this video, Peter Schiff notes that recent weakness in the US dollar is actually a strong positive signal for gold. According to him, even though bond yields appear to be rising, investors are effectively losing purchasing power, making bonds less attractive. Moreover, Schiff predicts that as confidence in bonds and the dollar continues to weaken, both central banks and investors will increasingly shift their capital toward gold. He emphasizes that central banks are already reducing reliance on government debt and accumulating gold instead, signaling a broader trend. Once gold begins to reach new highs again, more retail investors will follow this shift, especially if there is a downturn in stocks or cryptocurrencies. Such a scenario could accelerate demand for gold and silver, reinforcing their role as ultimate safe haven assets in a weakening financial environment. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Peter Schiff and francishunt's recent interview.
But, I think that interest in the metals is fading. They're not talking about them anymore the way they were back in February when we were going straight up, when gold was up over 5,500. There was a lot of discussion of gold, a lot of interest in gold and silver. All that seems to have disappeared, which, as far as I'm concerned, is actually better, because I liked it better when everything was quiet and nobody was paying attention to the gold rally, so my clients could keep buying more and more gold. All of a sudden, a lot of other people got interested and the prices started to spike. But I think that we're going to resume this rally without the fanfare. And I think that'll be a perfect backdrop for a big increase, because everything that is happening is bullish for gold. In fact, everything that's happened since gold started this correction is bullish for gold. So the fundamentals for gold today in early May, this is the first day of May, they're much better than they were in January or February when gold and silver prices were soaring. The fundamentals have really improved. And, the fact that the mining stocks were so weak, that really is reflective of a loss of interest. And part of the reason that investors are losing interest in gold and mining stocks is because the stock market's making new highs. This week, all the major indexes, save the Dow Jones, hit new highs. The S&P up 1% on the week, but made a new high. The NASDAQ up 1.4%, new all-time record high. Small caps are making highs up 0.6. I mean, the Dow was up, but not a new high. We're still on the south side of 50,000. But investors are, looking for risk. They're buying these stocks because they are optimistic. And when there's a lot of optimism, generally you lose some interest in precious metals, which are defensive safe havens. Now, why are they optimistic? Well, I guess people assume that this war is going to be over soon and oil prices are going to come crashing down. That's what Donald Trump says. He says they're going to drop like a rock as soon as we finish this war, and that bond yields are going to come down. But that's more hope than reality. Oil prices keep rising, and so do bond yields. In fact, oil was up pretty much on the week, although it was down today. But last I checked, it was about $102.50 on West Texas, and that's up from about $95 where it finished last week. So oil prices are not coming down. They're going up. Earlier in the war, back in early March, the stock market reacted negatively to rising oil prices. Now it's just shrugging it off because it assumes that the prices are going to come down. Same thing with bond yields. We actually touched 4.5% yield this week on a 30-year Treasury. We closed at about 4.97, but that's still up nicely on the week. And the 10-year Treasury at 4.38, we got to just above 4.4. But these are the levels around where the bonds were trading when Trump had to call off the reciprocal tariffs following Liberation Day because the bond market got yippy. Well, it's getting yippy again. In fact, it's going to be getting yippy-yappy. And these are negatives. The stock market investors are shrugging it off. But I think when the stock market investors throw in the towel on all this hope and the market gives in, I think you're going to see a decoupling. I think you're going to see gold and silver rise when the market's correct. Initially, they all went down together. The stock market went down and gold went down in tandem. Everything was kind of opposite of oil. That's kind of broken now. Oil keeps going up, but the stock market's going up, and gold's been drifting lower. I think the next move is going to be that the stock market goes down and gold goes up, and gold stocks go up. Because, again, war is bullish for gold. Inflation is bullish for gold. And the way you pay for wars is by creating more inflation. You expand the money supply. You run bigger deficits. That's what's happening. It's all bullish for gold. One of the things that I think is also a positive for gold was the weakness in the dollar. You know, the dollar index did reverse today, but intraday, it got down to about 97.7, closed about 98.2, which was still down, a little over 0.5% on the week. But when we got to 97.7, we wiped out all of the gains from the in the dollar since we started the war with Iran, all of it. And the rally that we had at the war was a very muted rally. It was not much of a bounce for a supposed safe haven. I mean, if you go back to wars that we might have started, 20 years ago, 30 years ago, the bounce in the dollar was quite a bit bigger than that. This was, nothing. And the dollar has already lost the entire game. And the next thing that's going to happen is the dollar is going to start to crack because it couldn't rally on the war, and all the fundamentals are negative for the dollar. Yes, people talk about, bond yields are rising. Higher yields should support the dollar. No, it's the short yields, and they're not rising. All they're doing is not falling because the Fed won't cut. But the one thing we know they're not going to do is hike. Meanwhile, inflation is going to keep going up. So real yields are going down, and bonds are going to get crushed. And when bonds are getting crushed, you buy gold. Doesn't matter that the yields are rising. The yields are only rising because no one wants to buy the bonds because they know they're getting screwed on the real rate of interest. And if no one wants to buy bonds, what are they going to buy instead? Well, the most logical choice is gold. And that's what the central banks are buying, right? They don't want treasuries. They don't care about that yield. It's not high enough to offset the purchasing power that they lose. And investors are going to be making the same conclusions. They are going to be moving out of their dollars, out of their bonds, into gold. I mean, you remember, no one's talking about it. I think, was it Morgan Stanley or some firm that started to recommend that the 60-40 portfolio be 60-20-20, where you cut your bond exposure in half and buy gold, right? That's kind of on the back burner now because, gold's had a correction and scaring some people out. But I think they're going to move that stuff to the front of the stove when gold makes new highs. And that's probably when you're going to start to see more talk. Gold will be able to quietly creep up back to new highs. Maybe silver too, although 120 is a bit high, but certainly over 100 by the time gold makes a new high. But who knows? I mean, maybe silver will rip again and beat gold to new highs. But I think once gold makes a new high, or maybe has to get over 6,000, you're going to start to see a lot more money being focused, retail investors, especially if we get a crack in the stock market, a crack in the crypto market. Another thing that happened in Bitcoin this week is they had the big conference in Las Vegas that I did not go to. I went to it a year ago. It happened in mid-May last year. This time it happened at the end of April. But when I went there a year ago, what was all the rage were Bitcoin treasury companies. You had all these companies that were copycats of MicroStrategy and now Strategy. The big one they all talked about was Nakamoto, and that stock's down over 99% because if you bought it at the last Bitcoin conference, you've lost 99% of your money between conferences. Well, the big talk this time was digital credit, and that's going to blow up. This is worse than subprime. This whole thing, is just a con. And more people are going to lose more money in this than to Bankman-Fried and his scam. This is the biggest scam, but nobody wants to call it out because it's being run by the messiah of crypto, Michael Saylor. But I think that during the second half of this year, we could see a big pullback in stocks, a collapse in crypto, and that's an environment where investors are going to return to gold, the ultimate safe haven, the ultimate store of value.
During the interview, francishunt explains that the gold-silver ratio is hovering near a key level around 63, 65.5. This level has historically acted as a strong zone of resistance and support, making it critical for determining the next move. According to him, short-term caution is necessary, particularly with seasonal patterns like sell in May and broader uncertainty tied to changes in Federal Reserve leadership, which historically have coincided with market instability. Gold may still be undergoing a corrective phase after recent sharp rallies, noting patterns like multiple sell-offs and weakening momentum on charts. Despite this, the long-term trend remains constructive as the intensity of selling appears to be fading. Supporting this outlook, recent developments show that central banks, especially People's Bank of China, continue to accumulate gold reserves, reinforcing long-term demand. At the same time, global uncertainty, currency weakness, and persistent inflation concerns are keeping gold supported near elevated levels, suggesting that any short-term correction may ultimately strengthen the foundation for the next bullish phase. Let's jump into the interview.
So I have two scenarios. It's important not to overcommit to any one thing too soon. There is a gold-silver ratio set up that causes me some concern about being too aggressive right now. And this is what we're looking at. So currently, we're at the 63 gold-silver ratio level. Now, you might notice also that there's a 65.5 blue line that's driven through there. And I'm going to take you to a higher time frame to explain where that line comes from. There's not excessive amount of stuff on this chart, but there is that blue line looming. What's behind it all? So I'll just remove the volume by price for a second and just illustrate. We have in our methodology something we call key levels of significance. And this 65 level is a key level of significance. And you might say, well, why is that? And I'll answer that. You can see that you were resisted in the relative valuations of silver and gold in and around the 65 to 67.5 area. I always expect a key level to just be run and then a reaction. Just rerun, then a reaction. Then we went very low vol and we broke above. What then happened is you came back down, only this time you were supported up there and you went away. You had an extreme event where gold was deeply devalued. That was the CV19 spill that was very destructive to silver. And you had a big dip down. And where did you get defended? Even though you ran on a spike quite a bit below 65, it's the 65 that got defended. Then we were in a holding box for quite an extended period. It was quite a boring era for the gold silver move. And we actually popped out the top before we eventually broke out the bottom. At this point, we were calling the gold bull is definitely here, this box running. And we said we expect the key level of significance of 65.5 to fail and for gold and silver to continue to make very strong upside moves. Then we got our, call it our, it's not even halftime, but I know you have football, you have quarters. So first quarter break on the gridiron, and we got this rally up to here. Now I am looking at that and I'm taking you back down to that rally. So you now have the virtual context of what is looking here. Now remember, a gold silver ratio upside move is actually bearish probably, and especially bearish for silver. Your question was, Francis, what does silver do next? And I'm saying to you, there is an either way move here, but my bias is we could actually have an upside move here, which could mean in a further extension sell-off on gold and silver, particularly with silver being higher beta, being worse served. And this gives a target around 79 to 80s level. So you could have a rally back above the 65 during a demand destroying event. This brings me to what I mentioned in the beginning of our interview. Sell in May and go away till St. Leger's Day, which is the pretty much for most people who don't know St. Leger's Day, it's the September period. It's shut up shop for summer, basically, is coming. Then we have a new Fed chair. There's often been crashes and corrective dramas. So Greenspan took over from Volcker in 1987. You might remember 1987 as a major crash year. This is a bit of a tendency. And then Mr. Bernanke inherited quite a bit of Greenspan's woes when Greenspan stood down. And there was each time quite a bit of contagion. Fed chairs are almost more important than presidential seats. I would say that they certainly are for as indicators for possible triumph. So we have Powell standing down. I believe it's his last speech today, in fact, and that you'll now be dealing with Walsh going forward. So I do see a little bit of a concern coming. It's not immediate, but this could happen, and then we could break upside, and that could see further downside. However, if this breaks down, we'll be back on the bull trade. So bear in mind, it hasn't shown its hand yet. I have a slight bull bias here that concerns me for gold and silver. Let's look at the charts itself now, if you're ready. But before I just jump in and carry on, let me hand back to you. Is there anything you want to jump in, or do you want to redirect it in any way?
No. Keep going.
So if I continue, as I will, XAU USD, and bring you to Oanda and show you. This is a little bit on the super macro timeframes, a shooting star for now. This incorporates the big blow off and now the sell off. Typically in candlestick charting, that points to the next period could be bearish. 6 months only ends in June, however, not in the end of April, but it's a slight warning. We would ideally like to see that warm up a bit and come back. If we have a look at the 1 month, you can still see a big candle bought back up and now trading lower. A little bit of a caution that it might be a longer wait than we think. We warned that there's normally 3 big sell-offs when you have a slap in the face like this. This was a jolt. That was a big sell-off. It was a real slap in the face. You got the second selling like this, and that broke that grind line. So the first time, everybody just seized it as an opportunity to come up under the gold market and buy. There's only one way. They've heard everything, the shortages, everything came up. And then there was a lot of money rushing in. That got exhausted. You could see we waited and we spilt. We broke that. Another sell-off, a new low. This was not high conviction. So there is more people hurt now. You can do it either as a channel, or you could have actually done it as a slight rising wedge, which might be marginally more accurate. So I'll just drop that to maybe a 12-hour just to get a bit more detail to show you that. But what we have got now is we've got a head and shoulder. Sometimes the dollar is part of the story, Gary. And what we like to do is we have a look at the other currencies. And for example, if I show you the forex.com, you have a very clean head and shoulder here. on this rally, and we were expecting a second sell-off where a lot of people were calling, no, you should already be long, and that exhausts the precious metals community because they go in and then they get sold off again. It feels awful. They're going, they buy and then they watch the market trade down. I can even take it to the 4-hourly there, and you can see we've got a downside target for the gold against the euro. That's replicated against the franc. I like to look at it against the franc, which is a semi-serious fiat, not a brilliant one, but at the least bad probably. And you'll see you have similar structure there. And it's also got a target to the downside that is needed, more downside to occur. So gold is still correcting a little bit on its third sell-off from the localized high. However, the volume and the thickness of these candles, you'll note my candles are varying sizes. You made a very good point about the short squeeze on the tech stocks. There wasn't huge volume driving it higher, you mentioned. And you can see here, this isn't as high a volume on the downside or as steeper decline. So if we just show you these candles, this was violent over here. So there is some dissipation, but this is pretty steady selling. And I think you'll probably make that target to the downside. I'm not so convinced that you'll make a new low. I think you'll probably bottom before. We have a broadening structure on gold, and we have a falling wedge on silver.
In precious metals markets specifically, post-rally consolidations have a well-documented track record of resolving higher, provided the structural demand pillars that drove the original advance remain intact. Understanding where gold prices sideways with long-term bullish outlook dynamics currently sit within this historical framework is essential for any investor navigating the 2026 precious metals landscape. Overall, the outlook for gold and silver remains a balance between short-term caution and long-term strength. On one side, institutions like Citigroup are signaling that while gold still has upside potential toward higher levels, the path may not be immediate and could require fresh catalysts. With central banks steadily increasing gold reserves and confidence in fiat systems gradually weakening, are current price corrections a temporary pause or the final opportunity before gold and silver enter their next major breakout? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.